Hello and welcome back to Financial Freedom Hub. Today, we're going to talk about return on shareholders' equity, or ROE for short. As you can guess, ROE is one of the important metrics that world's wealthiest investors use when they make those low-risk investment decisions that have made them millions and billions. Before we start, here is a suggestion. If you wish to become financially free, you might want to check out our playlists, where you can learn to interpret any company's financial statements with confidence, and you'll never have to rely on luck again. Shareholders' equity is the difference between the total assets and the total liabilities of a company. It can also be calculated as the sum of the company's common and preferred stock, paid in capital, retained earnings, less treasury stock. It represents the amount of money that belongs to the shareholders or the owners of the company. Shareholders' equity can also be seen as the book value of the company, or how much the company is worth, according to its balance sheet. Shareholders' equity sources are: firstly, when a company initially sells its common and preferred stocks. Secondly, when a company issues additional stocks. And thirdly, retained earnings, which is the money that the company keeps from its profits, instead of paying out as dividends. Out of these sources, the most important one for investors is the retained earnings. So, why is ROE important for investors? ROE tells us how efficiently a company uses its shareholders' money to generate profits. As a general rule, investors should prefer companies with high ROE because it indicates that the company is creating value for its shareholders. Low ROE, on the other hand, may indicate that the company in question is wasting its shareholders' money or facing financial difficulties. Sometimes, ROE can be negative, which might mean that the company is losing money and reducing its shareholders' equity. ROE can be negative if, for example, the company has a negative net income, which means that it is spending more money than it is earning. Or the company has a negative shareholders' equity, which means that the company has more liabilities than assets. So, what does it tell us? A negative ROE can be a sign of a risky investment because it means that the company is destroying its shareholders' value and may not be able to survive in the long term. But there is a catch. Some companies are so profitable that they don't need to keep their earnings. These companies may have negative ROE because they may have negative retained earnings. They may choose to pay out more dividends than they earn because they have enough cash flow and growth opportunities to sustain their business. And this is why we need to be smarter when looking at companies' ROE. To tell the difference between mediocre businesses that have negative ROE and excellent companies that can also show negative ROE, we need to look at their net earnings for at least 10-year period. If we see that a company earnings are growing constantly, over long period, even if it's occasionally showing negative ROE, we might be looking at an excellent company with strong competitive advantage that can make us rich and financially free. We hope you enjoyed this video and learned something new. If you did, please like, share, and subscribe to our channel. Thank you for watching, and see you next time.